Hey everybody, Scott Riley coming at you from the Market Update Desk Studios at Mortgage One, and it's the market update for April 10th, and it's not a fun day in the market. We did actually expect this, and we warned people about it so that we could be prepped with our borrowers and with our realtor partners writing in offers. The CPI, or consumer price inflation, came out today, and it's not far off what we expected. And the market, I actually should have worn red today because all the major indexes and bonds and everything is red. It's not a good day. It's pretty ugly out there, actually. Um, so the CPI came in and showed that the inflation rose 0.4%, which was a little hotter than expected at 0.3%, except if you look at the non-rounded number, it's actually 0.378, not zero point 0.4, but the media puts up 0.4 because these are rounded. So year over year, we increased from 3.2% to 3.5% on the headline CPI. That's hotter than what the market was planning on at 3.4. The core, which strips out the volatile food and energy, also rose 0.4%, but actually the non-rounded number was 0.359. Now the 0.4 was actually, also higher than expected at the 0.3, and year over year remained steady at 3.8%. But the issue is we expected that to come in to 3.7%. Now, what's really interesting when you get into the meat of this, and we'll go over this in a minute, and I'll put up a graph on it, 0.3% of the 0.378, or 80% of the total increase in inflation, came from two categories: shelter costs and automobile insurance. Those two categories just continue to give us a black eye. Auto insurance in total has gone up over 22% this year. We're all feeling it as we're driving our cars. So energy prices rose 1.1%, gasoline 1.7%. Used car prices actually fell 1.1%. That was a little bit of a positive. And as we talked about motor vehicle insurance, that rose 2.6% in 1 month. That is just kicking us in the teeth here. Shelter cost rose 0.4 and remained up year over year at 5.7%, which is actually a slight decrease from the 5.8% in the previous report. Owner's equivalent rent, that's the area that tries to capture this increase in housing that we've been hitting month over month. That rose 0.4%, up to 5.9% year over year. It's down slightly from the previous report of 6.6, which was in the rearview mirror. So overall, the CPI inflation, we warned everybody the replacement value that we were getting rid of was 0.18% last March. We knew we were going to get higher than that, but 0.4 really hurt us in the market. Now, yesterday, Apartment List sent out a note indicating that trends in Apartment List Index signal that shelter costs will continue to gradually, and I do mean underline gradually, fall in the months ahead. At the current pace, it's likely by the end of this year, we get under 3.5% for rents. Now that would be more equivalent with pre-pandemic levels, but this just shows we're not getting to where we need to get to quickly. This is going to be a slow movement to get to lower inflation costs. As we've been saying, to get to 2% target rate for the Fed, we're probably looking late next year, maybe the beginning of 26. That's what Neil Kashkari was saying a couple of days ago in a conversation he was having. He's one of the voting Fed members. This is going to be a slow slog. In fact, really the area that's going to get us to where we need to be is going to be the unemployment rate. We're not going to get it from the slow decrease in inflation. We're going to get this once we actually show real unemployment higher than the levels that we're seeing now. That's what's going to bring probably lower inflation levels and bring the Fed to a point where they can start to lower rates. Realistically, we started in December talking about 5 rate cuts. Then in January, that got cut to 4. Then that was from the huge employment numbers. Now we're talking, if we're lucky to, but likely, we're going to sit on one rate cut. And as I look at the Fed calendar, that's probably going to be after the November election, not before it. So we're going to probably start the trade line of pause for longer, not lower sooner, unfortunately, or higher for longer. It's going to be pause for longer. In fact, the 10-year bond, there's a 10-year bond auction today, which is going to be very, very important to see if these higher bond yields are going to attract some new buyers of bonds, which would help us a little bit blunt the hit that we're taking in the market. Mortgage applications for purchases were down 5% week over week. Refinances were up 10%. Yes, refinancing, consolidating debt, increasing your cash flow is very, very important right now. And if you call us, we can run the numbers, help you understand what your blended rate is, and save you some money. Mortgage-backed securities are getting creamed today. They were down 63. I'm sorry, mortgage-backed securities down 63 basis points so far today. 10-year bond up 14, and that's actually off its highs, which was about 18 up. We're sitting at about 4.478. There's the mortgage-backed securities are sitting on their 200-day level of resistance on the downside, so at least we have a floor being created. Stay tuned. The 10-year note this afternoon is going to be very important to watch. I don't think we're going to get to where we were hoping for on rates based on all this inflation data and jobs data. We'll continue to break everything down. Give us a call. Use our experience for you. Scott Riley, the Market Update Desk, your original singular news source for market information in the West Michigan area. Thanks so much. Have a great day.